Welcome to the Monday edition of Dividend Cafe, where this is definitely one of those Mondays that reminds me why I do the Monday Dividend Cafe in the way that we do, with the format we do. It also reminds me, by the way, of how much I love doing the Monday Dividend Cafe. It is, I find, productive, healthy exercise to go around the horn with these various categories and address the market relevance from things happening in public policy, the economic data, the housing market, with the Federal Reserve, and energy and so forth. So every Monday, kind of just trying to give you the main bullets across these different categories is our goal. And then every now and then you have a Monday like today, where in the few days preceding it, we just got an avalanche of different things going on that, like, if it were one of them, it would have been a pretty substantive Monday Dividend Cafe. And we had, I'm going to say, five things in the last few days that I want to attention today. So we'll go through all of our normal categories, but in each one of them, there is something, I would say, a little out of the ordinary. Now, some of these things were taking place in Wednesday, Thursday, Friday of last week. And so over the weekend, I got a pretty good head start on analyzing some of these things, on writing about them, and had kind of, prepared what the Dividend Cafe was going to be around some of the news, just from various tweets coming from President Trump to policy announcements, some of which were literally coming during the football playoff game on Friday night, for example. And then last night, Sunday night, um, we got word that the Justice Department had launched a criminal investigation into Fed Chairman Jerome Powell around his Senate testimony and what had happened with the Federal Reserve's building renovation. And Chairman Powell came out with a 2-minute video himself, and really, laying into the sort of political lawfare of the whole deal and threat to central bank independence from his perspective. And so that then forced me to kind of want to make sure I covered what was a very significant event in today's Dividend Cafe as well. Now, markets this morning, the futures were down about 350 points. Before that announcement came out last night, they had been up a tiny bit, basically flat. So they dropped in the aftermath of this news, which was pretty outrageous and just newsworthy. And a lot of times things happen that I don't think are as newsworthy as others may. But this is a big story. And then markets rallied throughout the day today. So that in and of itself represents a story that I'm going to get into as well. So that's just me kind of setting the table for all the stuff we're going to discuss here today in the Dividend Cafe. I will quickly give a commercial for Friday's Dividend Cafe. I don't want to stop talking about it yet. On Friday, meaning just a few days ago, our Dividend Cafe was the year behind, year ahead analysis that we do every year. For those who subscribe to and use our YouTube channel, there's an hour-long video with all the charts there. The podcast available at any podcast player you pick, and whatever you like to listen to podcast on, we hope you'll subscribe or have Dividend Cafe be one of the things that falls into your feed there. We always take likes and positive comments and all that kind of stuff. But then the written Dividend Cafe at the homepage, dividendcafe.com, we have a downloadable PDF, or you can read it on screen, of course, of the entire analysis. So it's a big endeavor. And if you're interested in a very comprehensive recap of last year and analysis around the year that we now are in, I would encourage you to go to Dividend Cafe. So as I mentioned, the market opened, actually, the futures were down about 350 at 4 o'clock this morning. But by 9:30, when the market opened here in New York, we were basically down a tiny bit over 500 points on the Dow. And that just lasted for a very short period. and markets began recovering almost immediately, and then throughout the day got back to the break-even point and eventually closed in the green, with the Dow up 86 points, which is just 17 basis points. The S&P 500 up 16 basis points, right at the same level percentage-wise. NASDAQ up a quarter of a point. My best guess as to why the markets ended up, first of all, had the initial response of concern around this Fed news and the questioning as to what it means to Fed independence, so what it might mean to ongoing uncertainty in both stock and bond markets, and why it ended up shrugging that off is that the pushback was not so much from the left today or even from other from the Fed itself. You know, every living Fed president came out with a big statement. Every living former Fed chairman, or in one case, chairwoman, came out with pretty vehement and I think articulate opposition to what has transpired here. But there were quite a few Republicans who, you need to remember, Stephen Myron, who is right now filling a temporary seat, his temporary term ends in 3 weeks. Um, there are vulnerabilities about the votes to kind of keep the sort of composition of the Federal Open Market Committee that President Trump would like to see. There's vulnerabilities around that. And I think that markets very likely today said that all of this jockeying and movement and maneuvering and whatnot is not very likely to go anywhere. And I think that's probably correct. So we shall see what ends up happening. I'm just going to skip ahead real quick to the comment I have in the Fed section since we're here right now. Let me take care of business while we're here. This was reported in the press, so this is hardly inside sources. I think it's more conventional wisdom. But I talked to a couple people who are inside sources that kind of verified the theory of the case is that the reason for this investigation is it's a little bit odd because Chairman Powell's term as chairman of the Fed ends in a few months, and by the time any of this could really go anywhere, he's going to be done anyways. So what is the real point here? But I think that people forget that the chairman term ends in May of this year, but his term as a Federal Reserve Board governor doesn't end till the end of January 2028. He basically has 19 or 20 months after the chairmanship ends, theoretically. Legally, that is how his term would go. But there is a very long tradition of when a Fed chairman, and in the case of Janet Yellen, chairwoman's term ends, that they have basically departed at that time, believing that to be the best move for continuity and so forth. It isn't universal, though. 1916, that didn't happen. The Federal Reserve Act, the ink wasn't even dry yet. But the last time that a chairman stayed when the chairmanship ended was 1948, Mariner Eccles, for those who know their Fed history. And I think that there is some question in the White House as to whether or not Chairman Powell would actually intend to try to stay after the chairmanship ends. I don't have any inside information as to whether or not he'd want to do that. I can't for the life of me imagine why he would want to. But my belief and the belief of many others is that this move is largely sort of additional insurance policy from the White House to try to make sure he goes altogether. It may have backfired to some degree because it has generated a lot of resistance from other Republicans, including votes that they would need for what's going to happen next. But that's about all I have to say about it, and we'll see how it plays out. All right, so I mentioned markets recovered, closed in the green, but not much, kind of, a modest up day, but a pretty significant amount of recovery throughout the day. The 10-year bond closed at 4.18%, which was up about 1.5 basis points on the day, so not much movement in the long bond. The top performing sector for the day was consumer staples, up over 1.4%. That the consumer staples and top of the market has not been said in the same sentence very much as of late. The bottom performing sector was financials, and I'm going to hold that thought when we get to public policy to explain what was going on there. The only other market comments I want to make, it's interesting when you go back to where the November market sell-off was, to think about the fact that the S&P 500 in that whole period from the peak to the trough was only down about 5%. But in that period, Bitcoin was down 30%, the semiconductors are down 15%, the total technology sector was down about 10%. So the frothier things of the market were down more, but the breadth in the market turned out to be much stronger, and things rotated in a healthier way. Small cap definitely caught a bid, and other S&P 500 sectors did as well. So I just think you can see in the way this has gone that the notion, which we've spent a good portion of my adult life in, of a binary either risk on or risk off, has not really been the flavor of the market lately, but more rotational and a question of leadership, but not all risk assets going up or all risk assets going down together. In the last couple months is, first of all, I think it's generally a healthy thing, but it's been more of the reality we've been in. Now, speaking of that technology sector, it really is kind of a mixed bag. The NASDAQ has not yet gotten back to its late October high, where you've seen Dow and S&P making a bunch of new highs. Now, look, it's very, very close, but only 60% of the names in the sector are above their 200-day moving average. That's not terrible, but it's quite lower than it's been, and it speaks to questions of just the valuations, I think, driving a little bit of concerns that linger. And then when stocks don't or can't make new highs or rally on good news, it does sometimes mean that we're facing a period of exhaustion. So it's something to understand. Q4 earnings season, which means Q1 announcing the results from calendar Q4, is definitely going to be very, very revelatory. I mean, across the whole market, but particularly for the technology sector. From a news standpoint, I think most of the big news stories were the Fed one I've already covered, and we're going to talk about some public policy and whatnot in a moment. But the other issue I'd put out there is what's going on in Iran. I would love to think it means that there's a changing of the guard coming and a kind of internal overthrow of their authoritarian leadership. But we have seen this before where it hasn't quite played out. So we need to give it a moment here, but I can certainly be praying. Okay, so into public policy, and now this is just a lot to chew on, but let me do it succinctly. The president announced on Wednesday he was going to seek a ban on institutions buying residential real estate, but he did state he would pursue congressional approval for such, and I just cannot fathom that congressional approval would be obtainable. He also announced Wednesday that he was seeking to ban defense and aerospace companies from returning capital to their investors. He also wanted to set compensation limits, forms of quasi-nationalization. I have personally talked to some members of the administration who have said that he hoped that he would forget he had said this. They issued an executive order today referring to giving some of these companies, I believe it was 60 days. It may have been 30, but I think it was 60 days to come back with proof that their timing of delivery of projects is on track and that they're not, suffering as a result of other capital plans. My best guess is that this was done as a way of sort of jawboning the companies, and not that there would be a serious and basically a legal policy, illegal without any kind of congressional legislation behind it. More of a negotiating strong arm tactic, and you could see how a lot of the stocks in the defense space that were down when the announcement came out Wednesday are all up huge since. Then on was it Thursday night, he announced that he was ordering Fannie and Freddie to commence a $200 billion bond buying program where they would have to buy $200 billion of mortgage bonds onto the balance sheet of Fannie Mae and Freddie Mac. This is basically quantitative easing, but with the GSEs instead of the Fed. And I will talk more about that in a moment. And then on Friday night, he announced that he was seeking, and this again was announced by tweet or social media post. I guess he uses, what is it, Truth Social for his social media delivery, banning credit card companies for 1 year from charging over 10% in interest rates. And this is identical to the bill that Bernie Sanders had put forward 11 months ago. Of course, it didn't go anywhere in the Senate then. This would require legislative passage, and I would just be shocked if it could go anywhere. But I mentioned the financials were worst performing sector today, big banks that have a credit card division, as well as the straight peer direct, if you will, credit card companies were down on the news. Although the downside didn't indicate to me anything that the markets were taking seriously this could actually happen. In other words, they were all down a bit on the noise of it, but I think they would have been down much more if people thought this were going anywhere. So, yes, lots in public policy, from the housing issue to the mortgage bonds to the defense sector to the credit card companies, and varying degrees of policy seriousness and concern attached. On Friday, moving on to economic data, the jobs data for December came out. 50,000 jobs created, well below forecasts, but probably worse than the 50,000 was that 2 prior months were revised downward by 78,000, 76,000. The labor force dropped by 46,000 people. So that caused the unemployment rate to go from 4.5% to 4.4%. So that's the unemployment rate going down for the wrong reason. Manufacturing, construction had net job losses. The monthly average in 2024 was 130,000 new jobs. The monthly average over the last 6 months has been about 43,000. So we definitely see a meaningful deceleration in the total headline jobs numbers. By the way, there was some noise last week, speaking of economic data, about the trade deficit dropping a lot. And with a hat tip to Peter Bookvar, I want to point out that some of the color that goes into it is very important. If you take out from the import data the flows of gold, which is not calculated in the BLS calculation of GDP, it's more of a monetary and currency item than a goods and services trade item. And you look also at the timing of pharmaceutical imports that were moved or front run in September instead of in October because of tariff related issues and timing. You actually see that imports went up in October by 1.5%. Instead of dropping by 3.2% when normalized for these two things. That's why I think some have not made as big a deal in that trade deficit announcement as they maybe would have wanted to. Fascinating report from the Duke CFO survey this morning. Vast majority of CFOs reporting no impact yet on productivity, employee retention, customer satisfaction, decision-making speed, or improvement in time spent on AI related, on value-added tasks from AI. The amount who said that they saw an impact of greater than 5% in any of these categories was almost non-existent. And again, somewhere around 70% plus seeing no impact at all. Again, perhaps the key word there would be yet. Then finally, I want to point out, as we get ready to go into earnings season, which starts tomorrow with JP Morgan releasing their quarterly results. Of course, we're always looking at updates at revenue, updates in earnings, forward guidance around both. But one of the things I think will be very interesting is to hear from S&P 500 companies in the weeks ahead, their hiring plans, to see if it gives us any indication as to what to be thinking about this labor data that increasingly looks Very, very dulled. In the housing and mortgage fund, I mentioned this $200 billion of mortgage bonds of Fannie Freddie. Look, it is not originating any new loans per se. These are loans already originated, already securitized, already put into bonds, and these bonds already held by other actors. But by having Fannie and Freddie buy that amount as a price insensitive buyer, buying a significantly greater than normal amount as a way of pushing yields lower. A big, heavy influx of buying relative to selling pushes prices higher, pushes yields lower, and then frees up liquidity on the balance sheets of the lenders that are selling these bonds to Fannie Freddie to theoretically be in a position to originate more loans. So it's a backdoor manipulation of mortgage yields, no question about it. Um, and I think that viewing it as QE, but not by the Fed, rather Fannie Freddie, at the instruction of the president, is a good perspective. And it ought to have some impact on the long end of the yield curve. But I have to say it hasn't yet. And I'm surprised by that. Um, Data from Reventure, which is a mortgage analytics company, 21.2% of all mortgages now are above 6%. That's the highest it's been in over 10 years. It was only about 6% of all mortgages were that high 4 years ago. So obviously the decline of rates has had something to do with it, getting a few more people to buy at that higher level, but not as high as it had been when the 30-year mortgage was over 100 basis points higher than it is now a year or so ago. But also, I think that some of those rates, like you look at the 2-year, mortgage with a 2 handle on it, somewhere between 2.5% and 3%, let's say, those are now just 20% of all mortgages. They had been 25%. So I think you see, certainly some of those people maybe have sold their house, but a lot of them, that rate had been locked for, let's say, 5 years. And now that 5-year reset has come and gone. And then finally, single family starts are down 7.8% over the last year. Multifamily starts are down 7.9%. For those looking for solutions to housing affordability, let me just say that that is going in the wrong direction. More starts, more inventory, more building is the need of the hour. Demand side solutions, I think, are counterproductive. The need is definitely for supply side solutions, and those are not really on the table. We've already talked about what transpired with the Fed and the motives behind it, and we will continue watching that news. Oil today was up 63 basis points, closed at 59.50. President Trump met with executives from all the big oil companies on Friday. And the only news we really got out of it is that he wants to leave Exxon out of it. There's a link in Dividend Cafe today talking about it, that Exxon, kind of reiterated the big risk in what is a geopolitically unstable country and what they've gone through over the years, having property confiscated, money stolen, and why they're hesitant to want to come back in. And President Trump saying, well, I kind of want to leave them out of it then. But other than that, no big news. He had talked about getting $100 billion of commitments from these oil companies, and there's been no such announcement since the meeting. But what else? Oil prices, by the way, the first week after the Venezuela military activity were up 3% on the week. So if the biggest story was how we're going to see a ton of new supply come online, you would think that would have pushed oil prices the other way. Sure enough, that did not happen. A lot of that has to do with just that the big, potential news is not really about new supply coming on the global market net, but rather perhaps replacing some of the other supply. And that's why I think you saw some Canadian companies down, and then the expectation that maybe there might be more supply coming from this particular South American country. So we've covered a lot here. Yeah, I've definitely gone longer than I normally do on Monday, so I'm going to let it go here. Clients will be receiving Wednesday a weekly portfolio holdings report per usual, and it will feature our first announcement from quarterly results, which start tomorrow. Earnings season is here. It's a reasonably light week as it does launch tomorrow with earnings, but then the next 2 weeks after that are a flood of companies, and I can't wait because I love earnings season, as do all of our analysts. If I can speak for them and members of our investment committee, Brian and I think it's a lot of fun, and I'm sure the analysts do too. It's what we do. In the meantime, look forward to being with you throughout the week. Reach out with any questions whatsoever. questions@thebahnsengroup.com. Thank you for listening. Thank you for watching. And thank you for reading the Dividend Cafe.